By the end of this video, you'll know exactly which mortgage loan type could save you over $65,000 on the same house. And most buyers never even ask about it. The last option I'm going to show you requires zero down payment, charges zero mortgage insurance, and carries lower interest rates than everything else on the market. But most people who qualify for it don't even use it. Grab a cup of water, settle in, and let's get into it. All right, let's start with something you can do right now, today. If you already have a conventional mortgage or you're about to get one. Conventional loans are the most common mortgage in America. About 70 to 75% of all home loans fall into this category. They're not backed by the government. They get sold to Fannie Mae or Freddie Mac on the secondary market. And if you put down less than 20%, you pay something called private mortgage insurance, PMI. Here's the thing about PMI. It protects the lender, not you. You're paying roughly $100 to $300 a month so your bank feels safe. On a $300,000 loan, that's up to $3,600 a year. Just gone. But here's what most people don't know. You don't have to sit there and wait for PMI to fall off on its own. The Homeowners Protection Act of 1998 requires your lender to cancel it when you hit 78% loan to value. But you can request cancellation at 80%. And that 80% doesn't just come from making payments. It can come from your home rising in value. Picture this. You bought your house 2 years ago. You're sitting at your kitchen table, scrolling through Zillow, and you notice homes on your street are selling for 15% more than you paid. You pick up the phone, you call your lender, you order a new appraisal. The appraiser walks through, confirms 20% equity, and that PMI payment disappears, sometimes years ahead of schedule. During the hot market of 2020 to 2022, millions of homeowners canceled PMI within 1 to 2 years of buying. That's $10, $15, even $18,000 they never had to spend. So if you have a conventional loan and your home's value has climbed, call your lender today. Ask for a PMI review. That one phone call could save you hundreds every single month. Now here's where things get more serious. Let's talk about FHA loans, the Federal Housing Administration loan. It sounds friendly. Low credit score requirements. 580 gets you in with 3.5% down. It was invented during the Great Depression when banks demanded 50% down and foreclosures hit $1,000 per day. The FHA created the 30-year fixed rate mortgage. Without it, homeownership, as we know it, doesn't exist. But there's a trap buried inside the modern FHA loan, and almost nobody explains it to first-time buyers. If you take an FHA loan with less than 10% down, which is most people, you pay mortgage insurance for the life of the loan. Not until you hit 20% equity. Not for a set number of years. Forever. All 30 years. Picture yourself at the closing table. You're initialing page after page. 40, 50 documents. Somewhere on page 37 of the loan estimate, there's a line item. Annual MI. $180 a month. You initial it. You don't think about it. But that line follows you home. Every single month, another $180 leaves your account. It doesn't build equity. It doesn't reduce your interest. It just vanishes. And every month you stay in that FHA loan after you could have qualified for something better, you're writing a check you'll never get back. Let me put real numbers on this. Say you're buying a $400,000 home. Your down payment is $14,000. Your upfront mortgage insurance premium is $6,755, rolled right into the loan. Then you pay about $180 a month in annual MIP every month for 30 years. Total mortgage insurance cost over the life of that loan, roughly $71,500. You saved $6,000 on the down payment compared to conventional, and it cost you $71,000 in insurance. That math doesn't work. Former FHA Commissioner Brian Montgomery said it himself. The lifetime MIP requirement added in 2013 created a product that, for some borrowers, costs more over the long run than it saves up front. The only escape? Refinancing into a conventional loan later. Freddie Mac found that homeowners who were financed out of FHA saved an average of $149 per month. Nearly $1,800 a year they were overpaying. Here's the honest truth. FHA is a loan of last resort. If your credit score is above 640, there are 3% down conventional programs. Fannie Mae Home Ready, Freddie Mac Home Possible, with lower insurance costs and cancelable PMI. A 2023 Urban Institute analysis found those programs outperform FHA for most borrowers above 640. Someone's steering you toward FHA without showing you those alternatives. Ask why. But that's not even the best part. If you're finding this helpful, subscribe. I drop videos like this every week, and the one I've been saving is coming right now, okay? Remember how I said most people who qualify for the best option don't even use it? In 1944, 16 million Americans were serving in World War II. Congress passed the Servicemen's Readjustment Act, the GI Bill, signed by FDR on June 22, 1944. The promise was simple. You gave us your youth, your safety, your time. We'll give you a future. That wasn't poetry, it was a contract. And part of that contract was the VA loan. It is, by almost every objective measure, the single most powerful mortgage product available in America. No down payment. Zero. No mortgage insurance. Ever. No PMI. No MIP. Nothing. Interest rates that run 1/4 to 0.5% lower than conventional. And since 2020, there are no loan limits. You can borrow above the conforming limit with no money down. Let's run the same $400,000 home. VA loan. Zero down. A one-time funding fee of about $5,600. Waived entirely if you have a service-connected disability rating of 10% or higher. Monthly payment around $26.31. Total insurance cost over 30 years. $5,600. One time. Done. Compare that to FHA's $71,500. The difference is over $65,000. Now let me tell you about James. James is a Marine Corps veteran, early 30s, living in Jacksonville, Florida. He and his wife, Maria, found a $350,000 home in 2022. Their mortgage broker showed them an FHA loan first. Monthly payment with insurance, $23.40. James sat at that broker's desk, pen in hand, the paperwork inches away. Then a second broker, one who specialized in VA lending, ran the numbers. VA loan, zero down, no insurance. Monthly payment, $22.10. James didn't need to bring $12,000 to the closing table. Over 30 years, the difference in insurance costs alone topped $55,000. He called Maria from the parking lot. His hands were shaking. "You're not going to believe this," he told her. "We don't need the down payment. We don't need any of it." James said something later that stuck. He said, "Nobody told me. I didn't even know I had this. I thought VA loans were for people who were hurt in combat." He almost left $55,000 on the table because nobody mentioned it. And he's not alone. According to Veterans United, analyzing federal mortgage data, only 57% of veteran homebuyers used a VA loan. The rest chose conventional or FHA. Paying insurance they legally never had to pay. Why? Myths. Sellers won't accept it. Not true anymore. VA offer acceptance rates are within 2 to 3 percentage points of conventional in most markets. It takes too long to close. Outdated. VA loans close in 47 to 51 days, nearly identical to conventional. You can only use it once. Completely false. VA loans are reusable. Multiple times. Chris Burke, Vice President of Mortgage Insight at Veterans United, the nation's largest VA lender, put it plainly. The VA loan is the most powerful home financing tool on the market, and too many veterans don't use it. 1 in 3 eligible veterans has never touched their benefit. This benefit nearly got killed by Congress in 1946. Fiscal conservatives tried to cancel it 2 years after it was created. Veterans groups fought to keep it alive. It's not guaranteed to last forever. If you're a veteran, active duty, National Guard, Reserve, or a surviving spouse, this benefit is yours. You earned it. Use it now. So, 3 loan types, 3 very different price tags, and 1 question that changes everything. Cancel your PMI early if you have a conventional loan. 1 phone call could save you thousands. Think twice before accepting an FHA loan if you have other options, because that lifetime insurance adds up to more than most people's entire down payment. And if you're VA eligible, use your benefit. It could save you over $65,000 that no one else at the closing table will mention. Here's the exact question to ask your loan officer. Can you show me the total cost of mortgage insurance over the full 30 years side by side for every loan type I qualify for? That one question puts you in control of a conversation most buyers never know they're losing. Think about James in that parking lot, hands shaking, calling his wife. That moment only happened because somebody ran the numbers. Be the person who asks. If this helped, share it with someone who's buying a home. Subscribe so you don't miss the next one. I'll see you there.